I think we'll get started now. Welcome everybody to the webinar today, and we have a lot to get to with respect to all of our discussion on the stock market, the economy, and how the presidential election is going to affect that, and our outlook for the rest of the year. So it's going to be a great afternoon that we have prepared for you. But just by way of introduction, my name is Nathan Crampy. I am the Vice President here at Summit Investment Advisors, and again, I want to welcome you to the webinar. Also, before we get started, I want to talk just a little bit about our areas of expertise and all the different things that we do here at Summit Investment Advisors. Let me do this. Let me pull up our website here, and this will give you a good understanding of all the different things that we do here. And right front and center is our areas of expertise. 3 distinct areas: financial planning, investment management, and estate planning. Now you can actually click on each link here and dive more into detail about that topic. So financial planning, we have not only our process that we go through here, but this really boils down to one major topic, and that's wealth enhancement. And what wealth enhancement is saying, how can we look at where you're currently at, take into account your needs, your goals, and then try to look at tax mitigation, looking at all the different details of how we can make sure that we can meet your objectives for the future. So that is all encompassing with the financial planning, and you can read a little bit more of that here as well. Next area of expertise, investment management. What we have highlighted on our website here is a lot to do with respect to just some of the different investments and tools we can use to work with your portfolios. But just like financial planning, this can boil down to one term with respect to the investment management, and that really is wealth preservation. Now, wealth preservation takes into account the fact that you have done such a great job over the years of accumulating money. Well, now let's try to make sure that it lasts. So we can provide risk mitigation. We can start going through different ways of kind of bringing in different tools, different investments that are going to meet your objectives to preserve what you've done a great job of accumulating over the years. So financial planning, investment management, and then the third area of expertise is our estate planning. Now again, we've highlighted a lot of different little details here, and this really boils down to 3 areas. First of all, wealth transfer. How do we transfer the assets correctly, not only today, but in the future? And then it also comes down to wealth protection, so guarding your estate against catastrophic losses. And then the last one is the charitable planning, making sure that as you have the wishes to give to charity, that we build that into the estate plan. So you can find all of this information on our website, summitinvest.com. I would like to introduce our speaker for this afternoon, Sean McDermott. Sean is the president here at Summit Investment Advisors, and he specializes in working with not only retirees, but also the medical device community. Here in Minnesota, there's been a lot of things that happen over the course of the years with respect to different types of companies not only being created, how they plan for employees, but more importantly, how we transfer wealth from one person generationally, but also how we plan for people retiring from some of these companies and the unique details behind that. And he's co-authored numerous articles on the taxability of company stock, stock option planning, as well as important here, some of the implications of inversions and takeovers and what they have on the stock purchase plan shares. So if you want more of that information, get in contact with us, and we have a number of white papers that we can share with you. Sean is also recognized in national publications like the Money Magazine, FPA, Financial Planning Association, as well as locally here in the Minneapolis Twin Cities Business Journal and the Minneapolis St. Paul magazine as well. And so it's my pleasure to introduce Sean McDermott, who's going to run us through a lot of what to expect. Sean.
Welcome to the webinar. We are happy that you have joined us because we feel these economic updates are of great value to investors in order to give you confidence in the fundamentals of the economy and, most importantly, help you stay focused on your long-term investment goals. A vote of confidence means having the belief that someone or something has the ability to succeed. Confidence gives discipline, which is so very important for a solid investment plan. 2017 will mark the 8th presidency that I have experienced since I began my investment career in 1989. Looking back to 1989, George H. Bush was elected president, and at that time the Dow Jones Industrial Average was at 2,168 points. Today, the Dow Jones Industrial Average is over 18,200 points. This represents a 16,000 point gain over the last 27 years, which on average is over 8% a year. And in addition to that, investors would have received over 2% in dividend payouts. So over the last 27 years, one thing that I can tell you for a fact is that through all these presidencies, the market has continued to go up. One of the truest time-tested quotes I know is that it's time in the market, not market timing, that counts. One of the biggest parts of my job is to help people make better investment decisions to grow their assets over time. Oftentimes during election years, we have increased market volatility and we get phone calls from investors asking us if they should take their money out of the market and put it into cash, and then after the election, put it back into their investments. Well, we're here to answer some of these questions for you today. And one thing I can tell you is that the two greatest enemies of your portfolio is the news media and yourselves. So with that said, let's take a look at what LPL economists have to say about the fundamentals of the economy and what they're expecting from the upcoming election season. The theme for the presentation today is a vote of confidence. We're going to focus in on 4 key areas. One is going to be Federal Reserve interest rates and rate hikes. We're going to talk about international opportunities or not. We'll talk about corporate America investments and what stocks and areas we think are going to give us the most strength. And we'll also look at the second half turnaround in oil prices, the stabilization of the US dollar, and also talk about corporate earnings. Some thoughts on areas of the market that we think are going to show some strengths in the upcoming months. We're voting yes for things like cyclical stocks. These usually benefit from ongoing US economic expansion and improving economic growth in the US and emerging markets. Good examples of cyclical stocks would be automotive manufacturers and travel and leisure time companies. We also think emerging market stocks are going to do well. They have very attractive valuations, which I'll show you in a chart a little bit further on here, which are likely to be boosted from fiscal and monetary stimulus in those parts of the world. We think master limited partnerships are going to be attractive because of the improving oil prices and the high yields that these are paying. And then other specialty investments like long, short equity funds as market volatility picks up. We think that it's a good idea to stick with or re-elect large cap growth stocks because these are well positioned for the mid to late stage of a business cycle. While growth stocks may demand a premium valuation in a modest growth environment, we think high quality intermediate bonds and corporate bonds are also going to be a good place to be. Areas that we're voting no to would be defensive stocks and then also large cap international stocks, specifically in Europe. So forecasting the future, we believe the US economy should grow at 2 to 2.5%, which are modest gains, and mostly that is going to be pushed along by consumer spending, government spending, and then in addition to that, the strengthening of oil prices. Stocks were anticipating mid to single digit returns at this stage in the economic cycle. And then bonds, low to mid single digit returns. Interest rates are at historic lows, and it's hard to get a good rate or a good growth rate out of bonds at this point. My next slide here on the economy shows that from 1997 through 2007, the economy grew at about 2.9% clip. Now from 2007 through 2016, the average economic growth rate has been about 1.7%. This is actually still good news, even though it's slower growth. We would say that it's growing at the pace of a healthy tortoise instead of a sickly hare. So economic growth and expansion is good for this country. Let's take a look at where the growth and expansion is actually coming from. The Fed says job target growth is 125,000 to 150,000 jobs per month. At this point in time, on average over the last several years, jobs growth has been 200,000 per month. And this is actually a pretty good number that we're seeing. The more jobs and the lower the unemployment rate, the more consumer spending we're going to see, the more tax revenue the government sees, and of course, the better the housing market is. So that's a very good sign. This next slide talks about inflation and where we're at with inflation at this point in time. You'll see that the green line, going back to the year 2000, inflation was right around 4%. Today, inflation is right around 2%. So that's well within the federal target of not having hyperinflation or increasing inflation, where they would have to be at a point to raise interest rates. The blue line that you see in this chart is actually commodity prices, and commodity prices have been all over the place, especially earlier this year when we saw oil prices decline. Last year, oil prices were over $100 a barrel. Now, oil prices are a little bit over $40 per barrel, and that's part of the commodities. The next slide talks about policy evolution in the area of trade, financials, and healthcare. So all three of these areas will probably see the biggest impact depending upon who's the next president of the United States. Both of the candidates have very opposing and polarized views in all three of these areas. And so what we're preparing for and thinking ahead about is how we might need to adjust portfolios depending upon who's elected. The outlook for overseas markets is somewhat uncertain at this time. Our economist at LPL is recommending a lower allocation to the global markets and international funds, and we're primarily staying domestic with our stock recommendations. As you'll see from this chart, going back to 2008, the US markets, represented by the S&P 500 index, have had a pretty strong price recovery up to this time. The green line represents the emerging market index, and the light blue line represents the EFA index, or the developed market large cap index overseas. So US market has performed much better than the overseas markets, and the message here is that having money overseas for the last few years has not added value and has actually reduce the rates of return on portfolios. Because the global stocks have not rebounded as strongly as the US markets since the recession of 2008, you'll notice on this chart that the price valuations, or the PE ratios, of US stocks are trading at a lot higher multiples, right around 16 times earnings, compared to the emerging markets, which are trading at more multiples of just a little bit above 10 times earnings, and the developed market international funds are more right around 14 times earnings. So there could be some value by investing overseas, some upside potential in these types of investments. So therefore, a lot of investors hold their positions with the expectations that earnings and the global economy will start to come alive and start to move forward for better investment returns. A couple of the positive tailwinds that we see coming up at the end of 2016 would be, first of all, the US dollar has turned into an earnings tailwind. What we mean by this is over 40% of S&P 500 revenues come from overseas. So in the year 2015, when the dollar was strengthening, every time the dollar goes up, the euro or yen dominated revenues are worth less to the US corporations. So you'll see here right now the dollar is not strengthening anymore. It actually weakened a little bit. And so this could represent stronger earnings in the second part of this year from S&P 500 companies. Another positive factor for US stocks is oil could show year-over-year price gains by the third quarter. When we look back to the year 2014, oil companies gave the S&P 500 earnings a positive 11% return boost. In 2015, because oil prices fell, that represented a negative 4% earnings fall in the S&P earnings. In 2016, as we've seen oil stabilizing and actually increasing in value, we think the energy sector could actually see some positive gains for the year. And so far this year, we have experienced that in investment portfolios. It has been somewhat of a challenge for investors over the last several years. Interest rates have plummeted to historic lows, and it's been said that 10 years ago that there were not any global government bonds that paid below 2% interest. Today, 80% of global government bonds pay below 2% interest rate. That can be a real challenge to investors that are seeking to retire and live off the interest from their investment portfolio. What it does is it forces investors to go out and find higher yielding investments and have broader diversification to their portfolio. So that's one of the advantages that we try to help our clients with, is finding other alternative investments in addition to their bonds. So what we're looking for are higher dividend paying stocks. We're looking for alternatives like MLP funds, REIT funds, and so on and so forth to enhance the yield in this low interest rate environment. Let's move on here and talk a little bit about the upcoming election and talk a little bit beyond the hype. I'm going to share with you next year some past election results and how it's impacted the market. But my main message here is to try to avoid, the media circus and the hype. And I said earlier on, the worst enemy of your portfolio is the news media and yourself. And there certainly is going to be media circus as we approach the election, our presidential election time. So let's take a look at some of the past numbers. One of the historical charts that we pulled up is one that gauges income growth and the impact on election results. So in years that after-tax income growth is above 3%, the incumbent party is favored to win. Right now, income growth in America is about 3.5%, and people vote through their wallets. So this would suggest that the majority of the popular vote would go toward the Democratic Party. What we're looking at here in this graph is a study that goes back to 1952 and studies 16 election cycles. You'll see that the average rate of return for the stock market has been a 10% growth rate, and this has occurred 87% of the time. So basically the message here is that presidential election years are really pretty good for the stock market. The blue line that you see in this chart is how our market has been this year. You'll notice that there was a big dip earlier in the year, and that was primarily because of oil prices. And then oil prices started coming back up. And then there's another dip in June, and that was the Brexit vote. There was a downturn in the market, then the market recovered quite readily. So main message here is typically election years are good years for the stock market. Here's some interesting history for you. This graph goes all the way back to 1901, and it looks at the history of political regimes, stock market performance under presidential and congressional party combinations. So we're studying the Dow Jones Industrial Average, and as you'll see that if we have a Democratic president and a Democratic Congress combination, the Dow Jones has averaged a 7.2% gain during those periods. If we have a Democratic president, Republican Congress, the average market gain has been 8.6%. We have Democratic president, split Congress, average gain is 10.4%. That seems to be the best combination. Republican president, Republican Congress, 7% gain. That's a possibility. Republican president, Democratic Congress, 2.4% average gain in the markets. And then lastly, Republican president, split Congress is a negative 4.3%. So that's not a very happy combination for the markets based on history. So what will it be, folks? We'll have to find out in November. Let's talk about how to invest, a campaign strategy for pursuing your financial goals. Our first campaign strategy is increasing the likelihood of positive returns by being in the market over longer time frames. You'll notice here that the S&P 500 price index, if you're looking at the positive returns based on a daily basis, it's a little bit over 50% of the time you're going to have a positive day with your investments. So it's almost like a coin toss if the market is going to be up or down over a daily basis. As you extend it over a weekly basis, you notice that the positive return odds increase in your favor. If you're looking at it over the years, 70% or better odds that you're going to have a positive return in stocks. If you're looking at it over the decades and over 16-year rolling periods, chances are you're going to have better returns on your investment. So again, it's always time in the market, not market timing. Summing things up, we feel that stocks should have positive returns this election year based on historical election years, and also the economy is moving along at right around a 2% GDP growth rate. Again, we think with this low interest rate environment, low unemployment environment, strong consumer spending, strong government spending, and strong housing market, we would recommend investing in domestic stocks, large cap in nature, growth stocks. We believe the energy sector is rebounding and coming back and has the potential to give you good dividends. Healthcare stocks is somewhat of a toss-up right now. It really may depend a little bit on who is elected, whether it's a Trump or a Hillary presidency. And then emerging market equities we're warming up to right now. There have been some positive returns in that part of the market from the beginning of the year. The bond market, we think that corporate bonds are going to be the place to be because they do offer a higher yield, higher interest rate than the government bonds. And so the bond market, again, it's a tough area to be invested, and that's why we would recommend using some other alternative investments, such as things like precious metals, managed futures, MLP funds, and REITs. That should round out your portfolio to give you a little bit better diversification, a little bit higher yield. Election day is coming up. Voting is about casting our hopes for a better future for our family, for our community, for our country. Only 57% of voters actually show up on election day at the polls. So what makes a democracy work is that all votes matter. Similarly, the collection of market days combined create a force of compounding for your investments. So keep in mind that one down day with the market or a down year with the market is unlikely to derail your long-term plans. Elections and investing are both fueled by consistent participation. With that said, if you'd like further details about the webinar presented today, we do have some white papers, we have the slides available. Feel free to contact us via email or our phone, which is 651-490-2939. That's 651-490-2939. If you'd like to have your portfolio reviewed, or if you'd like to have a second opinion as to what's going on in your portfolio, feel free to contact us. Otherwise, our next event is coming up on Thursday, October 29th. We'll be doing a comedy club night, which is going to be hosted down here at Axel's Radisson Inn right here in Roseville. We have a couple different comedians. We're going to do a little bit of, they're going to do some political stuff and some other fun things. The event is at 7 p.m. We will be having light appetizers and drinks will be served. So mark your calendars for Thursday, October 29th, and come out and have a little bit of fun with us before the elections. Thank you for joining us today, and have a good one.